wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions, are able to trade in a fair and efficient environment, have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance, as it is imperative for investors to be well informed in the fast-paced financial world. Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rulebooks of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Financial Independence, Becoming Your Own Financial Manager. My name is Shen Chu. I'm the moderator for this webinar. Now, our topic today is less technical but more casual. So we're gonna be discussing how do we achieve financial independence? How do you set financial goals? How do we make our do our portfolio allocation? So before we begin, as usual, disclaimer: whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He first indulged himself in the SME financing industry right after finishing his diploma in finance and investment in Tar College. He continues to pursue his interest in the finance and capital market by joining Rakuten Trade and TA Securities, which he held the position of Risk and Compliance Officer and Dealers Representative. To date, he has over 8 years of experience in the capital market as an investor himself, where he also runs Want to Invest, a financial blog which amassed over 60,000 followers to date. Max was also an associate director at a private equity firm and is now a senior partner for a corporate advisory firm. Currently, he's also a SGX Academy speaker. So he's none other than Mr. Max Tan. Max, how are you today?
Hello, Shane. Good evening. And good evening to everyone here. Hope you guys are doing well. I'm doing good.
Fantastic. All right. So maybe I hand
Yep.
over the session to you.
Sure. Thank you very much. Before Shane runs away, right? Because our topic today is about financial independence, and some of you or some of us, we might call it financial freedom. Before I let you leave, Shane, I just want to ask you, what is your ideal, the idea of financial independence or financial freedom? What do you think of it?
I would associate financial independence to financial freedom. When someone achieves financial freedom, it means that their passive income streams are more than their expenses. That's why they don't no longer need an active job to keep themselves afloat, while the passive income alone is enough to cover for all the living expenses. So that's what how I see financial independence.
Right. I think that is a textbook accurate answer. Thank you very much, Shane, for that answer. Now,
Okay,
um,
sure.
I will let Shane go now, and then we go into our topic
No, I'll be here.
today.
I'll be here. I will be observing your talk. Okay,
Right.
I just turn off my video only. All right.
Sure. Okay, so yep, our topic today is about financial independence and us, becoming our very own financial manager. Because if you don't, someone else will be managing your finance, and probably you would not want that, right? Once again, thank you very much for LifeChain for inviting me over, and thank you everyone for taking your time tonight to join our session today. Now, Shane has just mentioned what does financial independence or financial freedom meant for him. It's a very textbook answer, textbook accuracy. And for myself, right, feel free to comment below actually, what do you feel about financial independence or financial freedom? For me, although I don't know, the cam makes me look quite white. Actually, I'm quite black because of the diving activities that I went to, right? And for me, financial freedom or independence is whenever I want to go dive, just go for diving. Just want to go for travel, and I can go for travel easily. And most importantly, I think we share the same idea is that we want to work on something that we truly feel passionate about. For me, it's mostly on the investment industry, but for some of us, right, we might have the pressure, we have loans to serve, we have all different kind of liabilities, that we might not be able to work solely on passion. You have the boss that you hate to deal with. So being financially independent means that you may not need to deal with all these kind of issues, right? And yeah, if you join my session before, just a very quick disclaimer. So whatever we mentioned today is not financial advice. It's solely more of a discussion today, actually, and more of a sharing of my experience and some of the ways that I'm using right now. So we largely will not touch on equities today, but we might touch on different type of asset classes. So I might be a bit more biased towards certain asset classes, but that doesn't mean that you should invest directly onto it. So if you really need this kind of professional financial advice, I would recommend you to look for someone that is a professional or license holder. Okay, so okay, skip this part. Now, the first part that we need to go into today is understanding financial independence, right? What exactly is financial independence? I think everyone we have a different kind of idea on what exactly is financial independence, right? I maybe you take a 30 seconds for you guys to write down what do you feel when you see the word financial independence. Do you think of associate with freedom? Do you associate with money? Or do you associate with burden? What kind of emotions do you associate, financial independence with, right? But I'll be waiting for your answer. Looking forward to it for your sharing. And what Shane has mentioned just now is the textbook answer, which very importantly, the idea of financial independence, the word independent is that you do not have to rely on working actively, which means whether you are in a job, whether you are running your own business, right? You can sit back, relax, and you are still able to get income. Okay, in that sense, for example, if you are sick one day, where's your income sources coming from? You might still have your payroll, but for people that are running a business, once you stop, you might not be able to get any income. So the idea for financial independence is largely on having sufficient passive income, right? I will also debunk some myth about passive income to support your lifestyle, right? And also I will talk about the lifestyle part. A lot of people you see on a lot of financial books that you have to live extremely frugal. That means that you have to save a lot. You have to save non-stop, and you cannot enjoy life at this moment, right? You see a lot of topics discussion about the daily coffee that you indulge in. It might slow down your financial independence and whatnot. But personally, I would say that to strive a balance in between is more important, right? And I will explain a bit more later on. Now, what do I mean by, for those who have not involved in the financial industry before, or you have zero concept about financial independence, what does that mean? So I will give you three examples, right? Having a passive income means that you have a certain kind of asset. We'll talk about different asset classes later on. You have the asset that are able to pay for your expenses or your liabilities that you spend, meaning that some assets will pay for what you spend. Let me give you an example. Imagine if you buy a certain bank stock, and for every quarter, they are paying you dividend. So for those who are new to the market, dividend, it means that once a company they earn money, they will distribute part of the profit to their shareholders. That is dividend. So in that sense, when you receive the dividend and you spend the money, it's a form of dividend or passive income paying for your lifestyle or your expenses. Now, how do we categorize that? Now, do you work for that bank? Maybe yes, maybe no. But are you actively working towards that dividend once you invested? Basically, I would say no. It's up to the bank to work 24 hours to serve you as of course, serving their customers, and also serve you as their shareholder by distributing part of their dividends to you. That's the essential part of investing in companies. So if you haven't read a book and you are really passionate about achieving financial independence, I would strongly recommend a book to you, which is Rich Dad Poor Dad, which has literally changed my life and my perspective about money. And basically, the book would tell you the quadrant, which what does asset and liability means. In that book alone, it will tell you that asset is something that pays you cash flow, and liability is something that takes your cash flow away. If you go for accounting, right, asset may have the different meaning, but I think for street knowledge wise, rich dad poor dad probably have the better interpretation in that sense in our day-to-day living. Of course, for financial professional or accountant, that would be a different story, right? Another type, if someone is a bit more, aggressive, or someone would prefer to have a better lifestyle. So one of my friends shared with me, he say, Max, actually my idea of financial independence or financial freedom is that I can go any restaurant, I can order anything without having to see the price tag, without consequences. You can still do that irresponsibly. So at the beginning of the month, you receive your salary. Then at the end of the month, what accompanies you is either roti or is a cup noodle, right? So you spend a lot at the early of the month, and then by the end of the month, you have no longer have the money for yourself, right? But achieving true financial independence for him is that if I walk into any place, I can just spend the money reasonably, right? Without having to worry about the money. That is also a form of financial independence. And of course, to be able to choose to go to a dream vacation whenever you want, or to purchase whatever dream items that you have, that you want in your life, that is also a form of financial independence. So each of us, we might have very, very different concept of financial independence, but ultimately is to create, and not create, but to acquire, or create also can, to have some assets to pay off for what you need to spend. It's what we call liabilities or expenses later on, right? And I often see a lot of myths about financial independence. And since you guys are here, chances are you are already much more mature financially, right? You're willing to spend, after your long working hour or maybe a long business hour, you're willing to spend time to come here to um, learn further about the financial independence part. I think you are pretty much very much advanced as compared to the others. And the most important part in becoming financial independence, start now. That's the most important part. It doesn't matter that it's not perfect, but it's more important that you start now. So some of the common myth that we see in investing, right, is that wow, you need to be very, very wealthy to start investing. Now I don't know if you guys have heard of a phrase before. It's called um, as you start, you need to start to be great, right? You don't have to be great to start something. That is the absolutely same as investing or your path towards financial freedom or independence. No, you don't have to be very rich to start investing. You can invest now as low as 100 ringgit. But if you don't start now, the time is never. You will keep dragging on, dragging on, and dragging on. You miss out a lot of opportunities, and you don't build the habit of investing and saving. So no, you don't really need to be really wealthy to start investing. Investing is essentially for everyone, just that different kind of income level have different kind of investment, right? And another thing is that some of the people, they might associate financial independence with retirement. It means that once I reach financial independence, it means that I no longer can work. It means that I have to retire, but that is just simply not true, right? Financial independence, I think it's much more than that. It's not only retirement. It's more towards you have the freedom to choose when to work, what to work for, and etc. Right? And another thing that I always hear is that, yeah, I missed the wave of 20 years ago. I missed the wave previously. It's now too late to invest. No, it's literally never too late to invest. The best investment, of course, is yesterday, but you might start now. Most importantly, again, you need to start, and you might have a different pace again as compared to others, but it's very important to start now. And as I mentioned just now, to become financial independence as a normal person, right, you must be extremely frugal. I'm not sure if you guys heard of this term called FIRE, financial independence and retire early, which the concept of FIRE, it means that you have to live, some of it, they actually promotes to live extremely frugal to hit your financial goals as soon as possible. To the extent you have to eat Maggie on a daily basis, or you have to eat maybe nasi and then with curry, one egg, and that's it. That's how I used to live previously, but I stopped that living style very very soon. Number one, it's not really sustainable, and I think it's a bit extreme, right? We are human. When we do something overly extreme, chances are it will rebound, just like stock or whatever kind of investment. It will rebound and backfire on us. And some of us, when we hear that, wow, I need to live so frugally for what, right? And we get intimidated by the idea, and eventually we went off path, or we choose, yeah, never mind, we worry about that later on because I don't want to live so badly right now. It's not about living frugally, but to me, I think it's about making smart budgets, and have the idea of increasing income. We can discuss about increasing income, or feel free, to drop your ideas about, as an individual, what are the things that we can do to increase our income level. And of course, as much as we can is to reduce the expenses, but not to the extent that is too frugal in that sense. Not to live, I would phrase it as not living like a bankruptcy person, right? Um, Not sure if you guys have played a game before. It's called the cash flow game. In the cash flow game, it actually doesn't matter, not really matter in terms of the income the person gets. It's more of your style of spending and also the commitment you get. Of course, when I mention don't live so frugally, it doesn't mean that earning a 2005 salary and then you go for Honda Civic. That's financial irresponsible in that case already. So having a certain amount that are being saved and invested every month while not jeopardizing your style of living or the comfort of your living, I think that is the longer term way to go. Now, another thing is that we mentioned about passive income just now. We talk a lot about passive income generated from asset. Are passive income truly passive? I would say no. No matter what assets that you have invested, I think that it doesn't exist something that is truly passive in nature. For example, if you invest in a property, if you invest in stocks or bonds, I think you need to continuously monitor your investments. For example, if you invest in a property, you rent it out to someone else, or you hire someone to manage the property, you will still need to manage the tenant. For example, like to collect rent, to manage the tenant in the sense of you know uh, solving the problems like changing light bulb, cleaning the place regularly, or handle all these different problems that the tenant may have. So it's not really really passive in that nature. And for stocks, as I mentioned just now, if you are invested in a stock, you get dividend. But the company, the developments of the company, it might go better, or it might go worse. So you as an investor, you will need to spend some time to look into the financials of the company regularly. How regularly? It doesn't mean that, oh, every day I have to spend 50 minutes, sit in front of the computer, look at the charts. It's not for everyone. Um, Maybe on a quarterly basis, just look at what the company is doing, or if you have the time, spend 1 minute or so, every 1 or 2 minutes every week, just to read through the news, what has been going on with this company that has been invested. Or else, on a quarterly basis, just monitor the financial performance of that company. And every year, depending on number of company that you have invested, try to attend their annual general meeting, which is the AGM, where you meet with the management of the company, right, to discuss. They will share with you their prospects and developments and whatnot. You also have the opportunity to speak directly to the management of the companies that you have invested to understand it even better, right? And for bonds in relative terms to what we mentioned just now, stocks is lower risk in nature, provided you buy safer bonds. But you will still need to monitor the macroeconomic. It depends on what kind of bonds that you are investing into. If you are investing into a bond issued by a government, then chances are you need to monitor, the developments of that country and whatnot, interest rate changes in that country. You might still have the chance to lose money even in the bond market. Just look at the US bonds. You might still suffer capital losses if you go in at the wrong time, right? So there are no truly passive investing. You really need to spend time to look into your investment. Okay. And as Malaysian, we as Malaysian, I'm not sure if you guys everyone is from Malaysia here, but apart from us liking nasi lemak and comparing our food with Singapore and also queuing up, there's another thing that we like. We like to compare with other people. Now, financial independence or financial freedom is not a race. So do it at your own pace, do it at your own lifestyle. You don't have to compare with your path or your planning of financial independence to others. There's no meaning to it. It's very easily to get discouraged. For example, one day you meet with someone from your same college or same university or same secondary school, right? You get a different job, you have a different time committed to your job, and you get a different income. And you try and ask, how much are you saving? How much are you investing? It's almost impossible that you have the exact same income, exact time being spent on the job or the business, right? And if you compare apple with orange, then it's very likely that you will get discouraged. Why somebody are faster, quicker than me, in that sense. So it's not a race actually. It's do it on your own pace, and we'll talk about goal settings later on, right? And also another example is that if you are just starting, for example, if you join this webinar and you decided that, oh, okay, today I want to take the driver's seat of my own financial independence or financial freedom, and you try to compare with the high income individual, of course, as I mentioned just now, high income individual, there's a trap that they are striving or going for higher lifestyle, better lifestyle, I would say, better lifestyles. So that would mean they have higher commitments. For example, a better car, a better house, it will mean that their monthly commitment is higher, right? So behind the scene, you might see, wow, he has such a nice car, such a nice house. But behind the scene, I think the person will also stress about, having to fulfill the commitment that every month, whether you like it or not, the bank will knock on your door and ask you to pay for the loan, right? So I think it's very important to do it at your own pace and striving a balance, living at a comfortable yet a reasonable pace. Don't overspend and not living too frugally, as mentioned, or you will easily give up halfway, and that's a backfire effect as well, right? And okay, as mentioned just now, I've shared with you my own definition of financial independence, right? Which is I am able to go to travel, I'm able to go for diving, whatsoever, depending on whether I like it. As long as I like it, I can go for a vacation. Okay, and if we tone it back down, we try to look at the reality, right? This is a chart that I gathered online, the cash flow of a ordinary person, which is us, and the annual income versus the annual expenses, which is, I would say, quite accurate. Now, the retirement age for Malaysian has already moved to up to 60 years old, if I'm not mistaken. And ideally, we all try to stop working as soon as possible. Again, stop working means that you don't have to work because of money. You can still work on something that you are passionate or you're interested on, right? By the age of four, I would say 35 and onwards, it's very likely that you already have your own family, you have your kid, and you will have lower energy at 35 years old as compared to 25 years old. And you would want to enjoy life by then instead of keep on fighting for, more money and to fulfill your dream by then. And if you look at the chart over here, right? Basically by the age of 60, you already diminish in terms of your income. The chart here shows that is the active income, it's not a passive income. Your active income when you stop working is basically zero, nothing. So you will need to rely on passive income, which is the key topic for today. In exchange, your expenses may also increase by then due to inflation. Basically, it's something that you cannot run away. If you are able to clear off all your debts by then, I think you're quite lucky. Then you have to worry about your other kind of spending. I'll talk about other type of spending when we are trying to set up goals later on. So the idea here is that to show you, once you reach 60 years old, the comparison between your active income and also your expenses that are going on and on and on due to inflation, right? So the key idea is to build up your very own asset pool. So since you are here, right? If you are here with us, you can comment down below what kind of assets that you're aiming for. Is it stocks? Is it bonds? Is it properties? So feel free to comment down below. Later on, we'll discuss them one by one. Okay. And let's talk about a different type of asset and liability. I mentioned about the book Rich Dad Poor Dad just now. A misconception about asset. I think every one of us, we will buy something which is property very, very likely, unless you prefer to lease it. Most of us, I think, we own at least one property in our lifetime. Our government has a lot of initiative to support first-time home buyer, right? And if you are buying the house for your own stay, is it an asset or is it a liability, right? If you're buying for your own stay, basically the property, it's not generating cash flow to you as at this moment. So you are betting on the property that you bought. Hopefully it will increase in prices in future. So you will reap the benefits. But don't forget, you already been paying for the property now, right? And by that context, you are living at a net cash outflow in that nature. So in the textbook of cash flow wise, it's a liability, right? Because you cannot really rely on this property to give you your financial independence. So be very clear about the property that you bought, whether it's for your own stay. Own stay, when it doesn't give you cash flow, is not necessary an asset, because it's quite uncertain whether it will appreciate in value. Given the property market in Malaysia, we have already seen stagnant in terms of property pricing for quite some time already, right? And next, some of you that are newer in the field of the investment field. So you might think of, oh, I'm interested in investing on bonds, or I'm putting my money in FD, and I wouldn't really call FD an investment, right? It's because the name literally says fixed deposit. You will get a return maybe around 3%. Maybe if you have a lot of money, you can negotiate with the bank up to 3 point something 4%, right? I wouldn't call it really a FD, fixed deposit investment, because it's really for your saving of your money. If you look at the inflation data over in Malaysia, the official data shows it's 2%. But depending on your lifestyle, the true inflation, depending on the item that you spend on, I think it might be higher. And if you look at this chart over here, as I mentioned just now, inflation will increase your expenses over time, whether you like it or not. Just compare the coffee or the Milo that you consumed 10 years ago and against now, increased by very, very significantly. Then you do the math, whether it's really increasing by a mere rate of 2% or it's even more in that sense, right? And this might sound very subtle, increase, then increase, what to do with me? But whenever the inflation strikes, it would hit on our true spending power, which means the 1 ringgit now, it's definitely gonna worth lesser than the 1 ringgit. 1 ringgit now is definitely gonna worth a lot more than the 1 ringgit in 30 years ahead, because of the inflation. Things that you can buy with 1 ringgit now, you can buy more now as compared to 30 years later on, right? Unless we have a deflation situation, which is very, very unlikely. Okay, so whatever assets that you're trying to invest, I would say that you can aim for a target of 5% return and above every year, unless you just putting your money somewhere else to preserve it as the objective, but it's not growing to fight inflation in that sense, then it's okay. But if you are aiming for financial independence and you want to protect your spending power, I would say minimum On a minimal basis, you need a 5% return. Okay. And we also have stocks. Stocks itself is very volatile in nature. As you can see, if you have invested in the stock market, you can comment yes, or you can comment a one, right? Actually, the stock market is quite volatile in nature. Even the very blue chip stocks, if you look at the historical chart, they can lose up to 30% in value or 50% in value over the short-term period in the event of a market crash. Whether you can stomach this kind of losses is very important. So for those who invest in the stock market, usually I would tell them the first rule of investing over in the stock market is to invest the money that you can lose so that anything happens, it wouldn't impact your lifestyle, right? It's very, very important on that. Once you build up your wealth and once you build up your portfolio, then you can consider switching to something safer, maybe on bonds ETF, maybe on bonds itself, right? And of course, there's a risk to reward in that sense, apart from the dividend that I've mentioned just now. If you select the right company, you grow together with the company earns more money because they are growing. You also receive more dividend in return. Now, there are also other types of, I would say, alternative investment. For example, you saw on Facebook a special investment scheme from, or you pick up a random call calling you from one of the, broker house is quite famous nowadays. And they are telling you that there's a scheme that offers you 5% return every month. Okay, any one of you would invest in such a scheme, 5% every month, right? If you would invest in this kind of scheme, you can comment a yes. Okay, if you would not, you can comment a no. Okay, some of us here already know what's going on. Someone commented no. What about the rest of you? What do you think of this kind of investment schemes? No, Raza also mentioned no. All right. The answer is absolutely run away from this kind of investment. Yeah, it's literally 60% a year. If you look at any form of investment and they tell you there's a guarantee 5% return, it's definitely a scam. Immediately run away or you just shut their call down, right? Anything that offers you guarantee return is a scam. Even if you buy insurance policies that come with investment link, they will tell you that such investment it will not guarantee your result, right? Yeah, Kennedy and also John also mentioned that no, and also it's too good to be true. Absolutely yes. In Malaysia, every year we are seeing more and more scam cases coming up because of again, it's the issue of greed and also lack of financial literacy to understand these kind of things are too good to be true. So if you see this kind of scheme, apart from, it's very huge impact on your financial independence when your money got scammed away, it's absolutely zero in return in that sense. Also, you get a huge mental toll after you got scammed. So run away from this kind of scheme whenever you see it. And lastly, some of you might ask me that, oh, Max, what about crypto? Is it good for, building financial independence? Now, I'm not an expert on crypto. In fact, if you want a passive income from crypto, you can also do something called stake, which is something like pledging your crypto to the exchange, right? You can get different kind of APY, which is the equivalent of interest that you can get. And in that sense, you might still suffer capital losses because the volatility nature of that crypto. For example, if you get an APY of 6%, 8%, but the value of that crypto drops by, for example, 30%, you can still lose out, right? So crypto, due to their volatile nature, maybe you can have, I don't know, depending on your risk profile, you can have a bit in terms of your overall asset portfolio, right? But it's definitely not the, main one. If you want a stable portfolio, it's relatively highest risk. Of course, not highest, the scam, of course, is the highest, and also money games, right? So you have to figure out your risk profile and also the different kind of assets to invest in. Okay, but the next question is why? Why am I motivated to to become my own financial manager? Why do I need to care so much about money? It's actually quite simple. This is such a sensitive topic that you regularly, I think you don't discuss with your family members. But if you don't manage your own money, people basically no one will care for you except for your spouse probably. And there are people who cares about uh your money, but it's usually for their own good. It's usually beneficial from themselves. That's where they care about your money. So whether you we have different ideas about money, we have different emotions about money, but whether we like money or not, I think it's the currency for us to, live and buy goods and whatnot. Plus, if you look at the recent market development or the global development, whether we like it or not, with all these different kind of war ongoing, uh, tariff going on around the world, right? Basically, the inflation is for sure to come with all this uncertainty. And if you look internally, which is if you look at Malaysia itself, our electricity bill is likely to go up in conjunction with tariff increase. This tariff is different than the tariff that Donald Trump's mentioned. This tariff means that our electricity tariff, right? And with so much item that will be taxable on XST right now, which are what the government phrase as non-essential, basically the consumption power would further decrease because of the cost of the items it will increase. So if you prefer to do nothing, just live a carefree life, you like it or not, living costs are rising, so you need to deal with them eventually. It will impact your spending power, and plus, money is so wasted if you just leave it around there. So, for example, if you leave your money in banks where you put it in FD, right? Why do you think they give you the money? For example, why do you think they give you a 3% interest rate in the event of an Islamic bank? Why do they share the profit with you, right? Because they are taking risks with you, or they are doing something else with your money. For banks, some of the banks they might just rent it out there. Some of the banks they might do business on your money, right? So that they will manage the money on your behalf. How about investing in unit trusts, different kind of funds, right? You're entrusting someone else to manage your money to invest for you in that context. Sure. Does that mean that I can fully shy away? Let's say if I invest in a very famous fund manager to manage my fund for me, I invested in the unit trust or the fund of a very famous fund manager. Can I just leave it there? If you look at a lot of news that comes in Malaysia, after 10 years, their investment dropped by value of 30%, 20%, or they just reach a break even. So imagine after 10 years period, when you're breaking even in your fund, what is the net return of your fund? It's not breaking even actually. Every year, the fund will be charged a management fee. I'm not saying that's bad, but when you're charged a management fee, it reduces your actual profit from that fund, right? So it's not making you money. And after a period of 10 years, as I mentioned just now, inflation, your let's say you put in 10,000 into a specific unit trust, your 10,000 is no longer worth 10,000, even if the fund breaks even. You can buy lesser thing by then with 10,000, right? So you will still need to monitor very closely on the fund or the unit trust you invested. That's also one of the myths that I would like to mention. And if you look at the actively managed funds of Malaysia, actually there are a lot of them are underperforming. Might as well you put into some of the high yield banks that are available in Malaysia, or best EPF that's giving you the opportunity to invest more through their voluntary scheme, and they're offering 5 to 6% return every year. So active funds in Malaysia, unfortunately to say, they are quite underperforming. But the overseas ETF, probably you will see some performing ones, but they has been going up for non-stop for many, many years. So there's an inherent risk, I would say. Okay. And I would say that managing your own money and becoming your own financial manager is the first step to your dream lifestyle, right? You always strive to want something. For example, I want to go to whatever place that you want to go. Some people, they want to watch they want to see snow, or they want to live the foreign country when they retire, or they have something that they dream of. They want to live a lifestyle teaching people how to ski because you love ski so much. So to live on this kind of lifestyle, you need to first manage your money. Otherwise, it's very easily to backfire when you rush into this kind of lifestyle, which has a lower financial stability in that sense, right? So it's very important to start managing and understanding your own financial goals, which is the next part we will be talking about. Okay. So in our life, right, we have a lot of things or countless things basically if we are human. We have a lot of things that we want. But in order to achieve financial independence or financial freedom, we need to figure out what are the needs and what are the wants. For example, a new iPhone 17 Pro Max, is it a want or a need? I would say that for most people, that's a want, right? It wouldn't, if I'm using a iPhone 15 now, it really wouldn't impact me that much. It still performs, maybe not as quick, or maybe there are lesser function on it, but it's basically a want. But in other contexts, if I want to eat, I need the food. I need food. That's basically need. It's very simple. So you need to really clarify a morning coffee for you. What's the value does it bring to you? Can I get a cheaper coffee? If you are really having troubles, then you need to categorize it as a need. But to indulge yourself, maybe once per week or once per month to a fancy restaurant or a fancy coffee shop, um, emotionally, for some people, I would say that's a need. Otherwise, you get discouraged on the way of moving towards your goals to financial independence, right? So you need to figure out what is important for you. So how do you measure that? For example, I'm a coffee person. If you ask me to cut coffee, probably I get depressed. So to me, I think mentally that's a need, and it's not too much of a want in that sense. So as I mentioned earlier on, uh, try not to live overly frugally. We only live, not to ask you to go YOLO, but really we only live once in our lifetime. While we are being financially responsible, building towards our goal of financial independence, I think it's very important to maintain a certain level of enjoyment as well. So, what I did in the earlier part of my life, although I'm still very young now, is to figure out three things. My short-term goal, which is around less than a year that I want to achieve. My midterm goals, which are usually 2 and 5 years ahead. And my long-term goal, 5 years and beyond. What do I want to achieve? For example, at the age of 40, what do I want to become? Now, short-term goals are something that obviously you want to achieve in a shorter period of time that are money related. Okay, for example, you really want to go to have a short trip this year. By all means, if it really means a lot to you, emotionally and mentally important to you, you can set aside some money to go for that vacation. Or it's about buying something. It's buying a car, buying a property, as long as it's financially manageable and it's so important to you. Sometimes when you buy these kind of things, it would motivate you to get more income in that sense, right? So if you're able to save up and really have this kind of income, I see no harm in it. That's how I would interpret it. One mistake is that I made last time is that I would overestimate how much I can really earn over the shorter period of time, right? I set an overly high goal for my short-term goal, and it demotivates me when I'm short of the goal. For example, overestimated how much I can save, how much I can invest, and over stressing myself over the return over a short period of time. Let's say 6 month return doesn't hit my target, but in the reality, in the real life world, return on investments, it takes time really, right? And when you are demotivated or you are distracted, it will leave you astray from your financial goal, which is more harmful to you over the longer term in that sense. And again, I want to mention that life is short, right? That's why I personally, I would say mix spending and enjoyment, and while having a sufficient sum for your financial independence or freedom. Now you might ask me, how do I actually do that? Okay, you might you can search online the concept of financial jars. Or if you look into whatever, I'm not promoting digital banking, but I think it's fantastic that they have the concept of different sub-banking account. What do I mean by that? So if you open up most of the digital bank, you can set up a separate banking. I wouldn't say account, but like a pot that you can put in money into different pot. For example, for this, every month when I get my salary, immediately I would distribute my salary or my business income into different pots, right? The first one into is saving. Always pay yourself first. If you don't pay yourself first in for the context of investing and saving, you will always spend all the money, and by the end of the month, you have, I would say, it's very unlikely that you will still have money left for investing, because as human, we when we are living, not to say affluent, when we are living comfortably, it's very easy that we overspend sometimes, right? So to control ourselves, let's say I put aside 10% of my income every month to one of the pot to save and invest first. Then I will distribute the rest of my money into different bank account. For example, I have 50% to spend on necessity this month. If it exceeds your necessity, then you really have to look into it. Why? Is it an income issue or is it an expenses issue? So really look into it, right? And you can allocate the rest of the income. For example, for your midterm goal, you want a new property. You want to have a very fancy renovation for your new house. So you can save into, let's say, 10% allocate into renovation, another 10% into my goal towards my annual travel, and another 5% into charity. So it's something that is more flexible, as very adjustable depending on your financial situation. The most important part is to figure out short-term goal, your midterm goal, what do you want to do in the next 2 to 5 years, and long-term goal is usually what is the dream lifestyle or your retirement age that you want. That's over the 5 years and beyond period. Is usually longer in that sense. Okay. And when we talk about long-term goal, it's about wealth preservation. What do I mean by wealth preservation? And when I mentioned just now, when we talk about stocks, we talk about crypto properties, sometimes it's higher risk in that nature. Maybe property is still okay. But if you want to build wealth preservation, then you need to start looking into safer investments, and you need to build a legacy. You need to set up wills, need to set up trust and whatnot, to protect your wealth at that point. And ultimately, most importantly, is to achieve that financial independence that we are longing for. So the key message here is that don't overestimate what you can do over the shorter term. For example, chasing after returns that might discourage you, and don't underestimate what you can do over the mid and longer term. You'll be surprised, right? This is the lessons that I've learned in my past years. Okay. And how are we going to do that? Apart from the jar system or the pot system that I had just mentioned, I think there are some metrics that we can use, which I would say uh, that we can assist us on the way to financial independence, right? So financial independence is actually not something that after this session, magically you will have your goals or your dreams. I would say it's something dynamic that it will change along with your life. So for example, you develop a new hobby alongside your life. You realize that you want something so bad in your life, then you adjust towards it. So most importantly, you would have a process or a set of process that are able to help you to hit your ultimate financial roadmap. Something that is smart, right? Specific, measurable, attainable, and it's relevant. And most importantly, it's time bound, which is you can measure it by time. So if you have the luxury of time after the session, or maybe, usually I would recommend after the session when you're still a bit more fresh about the things that you have listened from this session, you can have your own me time. So sit down and try to figure out what do you truly want in life. It doesn't matter what other people's opinion are, right? Some people, they think financial independence mean that I have a yacht, I can travel first class or business class as long as I want. I can have that dream car, Ferrari, Bugatti, whatsoever. It doesn't matter. Don't care about what people think about financial independence. If your financial independence is that I want to eat whatever I want to eat, um, I don't have to worry about, it's about mental sometimes. I don't have to worry about debts, worry about working tomorrow, whether I will lose my job. Don't care about what other people look at you. But of course, as long as your goal is legal and ethical, I think you should work towards achieving it, right? And in terms of the time frame that I mentioned just now, don't overestimate what you can achieve over the shorter period of time, right? It will really stress you out, and ultimately you might give up on whatever you want to achieve and you get demotivated, right? Most importantly is you start, at least you are moving towards your goal. That's the most important part. And also attainable. Try to make it as something that is genuinely possible to achieve. For example, you tell yourself, I want to be a multi millionaire. I want 100 million in 2026. I would not say it's literally impossible, but the chances are extremely low. Either you go for lottery, which is not legal for some of our friends here, right? Either you go for lottery, which I strongly don't encourage gambling. It's basically very easy lose of money. And when you get addicted, it get worse. You will stray away from your financial roadmaps. It's get really worse. So you see a lot of family actually uh, got broken up because of the gambling nature, right? Other way, realistically, you want to hit 100 million in next year, is very easy. Go to your local money exchange and then ask to change your ringgit into Zimbabwe's currency. It'll make you a millionaire overnight, or Indonesian rupiah, or Korean won, right? So that's joking, but try to figure out something that's really attainable, really makes sense in that nature, and it should be something measurable, so that when you are there, you will note that, oh, I already achieved what I want. It's also give you a sense of achievement in that sense. So again, need to be specific on what you're trying to achieve, and it should be measurable in terms of quantifying it, right? Maybe it's your total investment portfolio, whether it's a certain sum of money or whatever ways that you want to measure it, and make it tangible, right? Something you can measure, attainable, making sense. Things that are making sense is not 100 million over the next year, right? If you're able to achieve that, congrats. Maybe you have a startup or whatsoever, and make it relevant. Don't get impacted by others. Like, for example, if you see your neighbor buying a new car, or your peers, they're giving you peer pressure, they're buying some luxury items. Don't get pressure into that. Stay relevant to what your current dream lifestyle, your current lifestyle are, and does it fit into your long-term goals? And also set a time frame, review it every year, see whether are you on the way, or is within the time frame to achieve what you truly wanted to achieve, right? And uh, ultimately, just to recap, I think the financial strategy here is just to increase your passive income to overtake your current expenses. Um, Try to be true to yourself. Let's not try to over or underestimate what I will be spending in the future. It's very easy. You can just take out your credit card bill or your bank statement or your digital wallet. Just look at what kind of things that you have spent. What are things that you can truly phase out, and then you try to work on the numbers from there. For example, if you are truly free from all these loans, right, you still need to pay for a lot of things. Number one, food, groceries, utilities, which are your water bills, electricity bill, mobile phone, internet, other household items, kitchenware, your shampoo maybe, and your insurance, your out-of-pocket medical expenses. You might need supplements, medications, petrol, maybe no petrol because you're driving EV, but you still have to pay for the electricity. car maintenance, road tax, public transport, your annual leisure expenses, which means that you set aside a sum of money that you will spend on leisure activities every year, donation, or maybe other miscellaneous expenses, for example, for your pet, for your own electronic devices, your technology upgrade. So reverse calculate and reverse to work it out on, I think is very, very important. As a rule of thumb, you can try to figure out your monthly expenses first, then you try to times 12, which then you would receive a annual expenses needed. And then to work it out, you will need to add on 3% inflation rate every year. Then when you measure it over for the long-term goal, you can see that by the age of, for example, you are 30 years old now, by the age of 40 or by the age of 50, what is the inflation adjusted passive income that I would need by then, right? So if you really need this part, someone to help you, you can always get a professional financial planner. I believe they always have the calculation to assist you on that. But if you want someone to help you, you have to be a bit more open to them in terms of your spending habit, your spending behavior, and your current income and whatnot. So if you're a bit shy away from that, you can also do this on your own. I would believe a lot of tools that are able to help you to work on that, right? And again, I want to reiterate really is that saving is not enough. If you are just putting your money in the bank, you will lose out to inflation, right? So, and also the huge potential of missing out on investment opportunities, because this is a session about financial literacy and also investment. So I really need to reiterate many times that looking for the suitable investment for yourself, compound it over a longer period of time, you will see a huge difference. This is the difference between the return of 2% and 7% over 30 years, right? For the same amount of investment capital. So you can see that it's much more than 2.5 times in terms of the total return generated, just because of a 5% annual compounding return in that sense. So it's very important to select the right kind of investment that can give you a reasonable, as I mentioned just now, at least 5 to 6% return every year on an annual basis, right? So in this kind of scenario, you have to understand that time is your buddy. The longer the time, the more time you can get, the money can get compounded and you move closer to your financial goals. So if you look at the wealth of the legendary investor, Warren Buffett, the wealth actually compounded even more astronomically by the end of his, not the end, but the more recent times. You see that the upwards movement of his investment is very drastically moving up only by the past 10 to 20 years, right? So compounding, again, leverage on it is very important. Okay, so we're just gonna not gonna dive in too much because we already mentioned quite a bit on the different kind of asset classes. So government bonds or whatever kind of bonds is basically, usually there are different kind of bonds. You have zero coupon bond, you have a fixed coupon bond, you also have some bonds that would give you a convertible nature, right? Back to economic class 101 or financial class 101. So it's very important to understand the nature of the bond that you have invested. Are you investing into the bond to strive only for coupon return, which is a fancy term for interest, by the way? Are you striving for coupon return, which is a fixed income? Or are you also looking at the convertible nature, which means some of the companies, when they want to borrow money, not necessarily they go to the bank and borrow money. They can also select to go for bonds. In some events, some cases, they go for sukuk, right? So they can raise fund and in return, they will pay you interest, which you get a bond. Some of the company bonds you can actually convert and become their shareholder. So it really depends on what kind of bond that you're looking into. If you are also looking at the potential of a capital gain, then convertible bonds that are offering coupon payments, I think it's quite interesting. Okay. And of course, properties. But as I mentioned just now, properties in Malaysia, except for commercial and industrial properties, for residential properties, I think we have been stagnant for quite some time. It's no longer pre-2014 era where a lot of upside are available for the properties. Now I think the time has changed quite a lot. So if you are investing into a property, and as I mentioned just now, the concept of an asset giving you cash flow, right? So you really need to understand whether this property, is it an asset or is it some place that I choose to live at, which is expenses in that nature, right? So if you're looking into properties, you really need to segregate that out. And of course, stocks are my personal opinion, my favorite asset class because of the high liquidity and also the it's you are entitled to capital gain. If you are good at it, you get capital gain. You can liquidate it at anytime. In Malaysia, fortunately now we do not have capital gain tax yet. We don't know what the government will do, but we do not have it yet. But if you look at the US, you get tax 30%, right? If you are a US resident. So there are risks. Of course, there are risks when you're into stock. You get capital gain. You also have the downside where you may lose out on your investment, right? But at least it's liquid. You can go for capital gain. You can also go for potential dividend, which is uh, giving you a fixed, not fixed exactly, but more stable return over the dividend. There are lots of companies on Bursa Malaysia that are giving you stable dividend, right? But you have to be careful that some of the companies that are sunsetting, right? That's a completely different topic on how to choose dividend companies. And of course, unit trust, funds, and whatnot. As I mentioned just now, a lot of digital tools now are available, right? I'm not trying to cut off, some agents, but if you go through online, uh, if you are good at it, you might save a lot of time. Sorry, you might save a lot of money because of the capital, the sales charge that you might be charged. Just give you a context. For some of the equity fund, if you do it buy online, your charge could be anywhere around 2.5% to 3%. But if you go through an agent, probably you get charged 5%. And again, you must think that 2.5% and 5% probably is nothing, right? But if you compound it over a longer period, you need to understand that when you buy into unit trust or whatever fund, it's usually they have already deducted the expenses or sales charges. So a 2.5% and a 5% difference, it means that you have lower starting capital and you compound it over a longer period of time, it really shows out. Okay, so it's very important on that sense, right? You can choose to use online tools, and I think there are a lot of robo advisors now available, right? And lastly, cryptocurrency. Personally, I would think that it's a relatively higher risk kind of asset. Probably one reason is that I'm not too familiar with it, but given the volatility and also the recent movement of uh just look at all these what we call stable coin returns, right? If you look at them, the volatility, the movement, even the most stable one, they can move 10% up down in a single day. I wouldn't call that stable. And if you are striving for retirement and financial independence, just imagine you're having a portfolio of 90% of your money in let's say Bitcoin, right? No, again, no buy or sell recommendation. Let's say Bitcoin. Tonight, there's a news that is beneficial for Bitcoin. Your portfolio went up by 10%. You're very happy. Next day, the news pull back. Your Bitcoin dropped by 15%. So imagine you have to worry about your retirement portfolio up down on a daily basis. I would really wouldn't call that financially independence, right? That's we're still so dependent on the movement of the market. So crypto, maybe you want to speed up your process. Maybe you can have some crypto in along your way, but again, I would say that it's relatively higher risk kind of asset. Okay, and now lastly, before we move into Q&A, I saw some questions here already. So feel free to comment on or put in your questions in the Q&A box. We are happy to answer them later on, right? So some of the things that I want to recap before I move into the Q&A session. Number one, always remember, don't stray away from your own goals. We are human and we get tempted all the time. Whether it's getting tempted for, buying a luxury items just because you're saying, again, why do I keep mentioning don't compare with other people? It's your own game, right? If you look at your peer, he just got a bonus. You also received the maybe same or even higher bonus. So you go and buy a luxury watch. And second day, when you go into office, your peer is showing off his new luxury watch. So what do? It's very likely that you think that, oh, I can also afford one and maybe a better one. But would that make you stray away from your own financial goal? So think of it, try to, for myself, yes, I get tempted again from time to time, but I will sit down and give myself probably a 3 days cool down period. Do I really want this item? Is it really worth it that I pay this amount now and it jeopardize my financial independence plan, right? If after 3 days, I would think that the item really meaningful for you. You really like the item, and if it's not too bad, not too big as a strain on your financial independence plan, I would say that yeah, probably you can consider that. But after 3 days, if you cool down and you think that nah, it's not so important for me, so I would say some cool down period is very good for you, right? So again, it's not a race. Don't get distracted. Don't compare with other people. You get compare. Even if you don't compare, people will come and compare, and you got triggered or you got envy. We are human. It's very normal, right? Be jealous on this kind of thing. So don't stray away from your own goals. And again, I have mentioned just now, thankfully, everyone here are very intelligent that you know that what is a scam, right? Never ever agree to get rich quick scheme. I think around 8 to 10 years ago, Malaysia, we have a lot of this kind of money game and a lot of, at the time, crypto was just starting. People are camouflaging crypto as with money game. So they say, oh, we are investing into digital asset and whatnot, right? Just to, again, we have a short term, mid term, and long term goal, right? Don't underestimate or don't stress yourself too much over a shorter time period that you would opt for get rich quick schemes. For example, they promise you 100% return. Even to this date, we are still seeing the newspaper saying that teacher, lawyer, doctor, it doesn't matter your occupation, get scammed hundreds of thousands of or even millions of ringgit away, right? Just because of the feeling of greed. So get rich quick whenever you think that something is too good, probably it is too good to be true. So be very careful on this kind of scheme that offers you something that just doesn't make sense, right? And just want to expose a bit and for everyone information. Nowadays, if you are on social media and if you happen to came across the advertisement from some famous, whether it's YouTuber, whether it's a influencer, it's very likely that it's a scam. It is going through the advertisement method. So just click into the profile, right? If you see a very low following, or it doesn't make sense in terms of the things they say. So be very careful on that. So you unfortunately you can try to report, but I don't think it does anything. Unfortunately for Meta, right? So yep, be really careful on this. Okay. And the concept of sometimes slower is faster. This is something that I learned personally. Which if you trying to rush yourself too much, you will make wrong decisions very easily. Uh, give you an example in terms of trading. Sometimes in trading, people strive to get more return, right? But when you are chasing after more return, it's very likely that you will need to make more decisions. Now, how likely are you to make 20 correct decisions or to make one correct decision that is profitable? I would say to make one profitable decision rather than all 20 are correct. So if you're rushing towards something or if you're chasing after something, you are easily manipulated and it's very easy for us to make mistake when we are rushing for something, just like your work. right? So sometimes cool down and stay slow. It will help you over the longer term, in fact. Okay. And again, as I mentioned just now, enjoy the journey to financial independence. It's not a suffering process that you need to suffer every day, eat roti plus kaya, every night Maggie. No, but try to work out a balance that it's enjoyable, but yet you can still arrive at financial independence or financial freedom by the end of it, right? That is very important. Why? Is because we only have one life. You never know what would happen, touch wood, right? If you save, and something unfortunate happen, you never even enjoy the life before, right? So, okay, I think that's my sharing on the topic of why. I think more today is more towards why and some of the tips that you can leverage on to become financially independent, or some of the things that, or maybe ideas, or maybe mindset in your pursuit of financial freedom or financial independence. Okay, I think we can move on to the Q&A session now.
Thanks so much, Max, for dissecting financial independence and show us how do we monitor our finance, how do we build our portfolio, how do we set our financial goals. So if you have any question to ask our speaker, you may write them at the Q&A box. The first question I see on my panel is, will gold investment be part of your portfolio? In the long run, will gold be a good investment? What do you think, Max?
Okay, I would say traditional, I mean textbook answer. Gold is something that you hedge against inflation. Why? It's because the uh because of the scarcity of it, right? Gold, there is limited gold on earth. There's only so much gold that we can produce, and everyone we are gold chasing after gold. So if you look at the history of the world, and before every war, every country is talking for gold because of the it doesn't matter the World War I or World War II, people are they want to save gold in term as compared to currency, or it doesn't matter what currency by then if there's a war breaking out, because the currency, every country's currency, the fundamental part after the Nixon agreement is on the trust, right? It's the trust that the company, it's the trust that the country can uh they can materialize that currency. For example, why is US dollar so strong? It's because that you believe that they are the strongest and the most commonly used currency around the world, right? And for gold, back to the question, for gold, I would say it's a hedge against a lot of uncertainty. And I would say it's a hedge against the currency depreciation and potentially inflation. But now, if you look at the gold movement, which has increased very, very substantially, right? Personally, for me, gold is not in my portfolio, at least not a lot, maybe just 1%. It's just for taking advantage of the gold upwards movement. Because if you think of it, gold, when it sits there or you put under your pillow, it won't generate you any cash flow. So you are relying on external factors such as uncertainty, inflation, and you are leveraging on the potential capital gain. Really, it doesn't generate you any cash flow in your period of holding the gold itself. So me personally, I wouldn't put a lot of money into it.
Right. Thanks, Max, for sharing your perspective. So the next question is by Guna Balan. In Malaysia, are there returns better than EPF's 5 to 6% return a year? It looks like EPF is a safer option than ETF, unit trusts, and similar investments. What is your thought?
Okay, I think that's a very broad-based question. Yes, to answer your first question, are there returns better than EPF 5 to 6% return? Yes, but you have to take on a higher risk, right? As some of our friends here discuss about risk, you have to take on higher risk if you want a better return. So if you compare with ETF, we have a lot of different exchange traded fund. We have equity ETF, we have index tracking ETF, we have bond ETF. We also have gold ETF, which is tracking on commodities. We have inverse ETF, which is moving on an opposite direction on whatever they track. We have leverage ETF that is, you would have higher movement. It's just like warrant. You have a higher gearing impact, right? So, is it safer than ETF? Based on the past performance of EPF, I would say yes. If you look at ETF, unit trust, and also similar investment, at least when you talk to your friend, you don't hear them saying, "Oh, I lose money in EPF." So it's something that basically never happened, right? And it's giving you a 5 to 6% return. Plus, it's something that mandatory. You really cannot run away from it. So if you have the option to get a 5%, 6% return every year, uh, as compared to ETF and unit trust, as I mentioned just now, actually a lot of them are underperforming over in Malaysia. So I would say, to answer your question, yes, it is safer option in that context.
All right. The next question is, what is your thought on investing in real estate investment trusts versus investing in physical properties from financial independence and retire early kind of perspective?
Okay, I think in REIT you will get potentially slower return because your upside is basically capped. It's quite capped on the distribution or the income that the REIT is able to generate. But when you are buying a real property, you are entitled to the potential rental increment. So for example, if you buy a property, its nature is for investment, and you renovate the property, you rent it out at a rate that is higher than your monthly installment, right? So excluding the fact that you already sunk in some money for renovation, you will get a positive cash flow from that property. Not to mention, if you select the right property, you'll be entitled to capital gain, right? But if your goal is to retire comfortably, probably REIT is a safer option. Why? It's because better REITs are not the funny REITs, but the better REITs, they are usually offering you a very stable return. In Malaysia, the average probably around 6% in terms of the REIT, right? But for a physical property, you will need to manage the tenant. They could call you at 2 a.m. in the morning and tell you that they do not have internet. In that case, is it something that you are able to accept in your FIRE lifestyle? Some people can accept, right? And also I wouldn't say we see a lot of cases of property depreciating in prices, but there's pros and cons in that sense. I would say that REIT is more suited probably towards the FIRE, and physical property, when you have to manage it actively, is probably take up a lot more of your time, and also you might not be able to rest so well. Yeah.
Thanks, Max, for sharing your perspective. Now, the follow-up question on this financial independence, retire early kind of methodology is that this methodology uses a 4% safe withdrawal rate, assuming that an average investment return of 7 to 8%. So, will this approach or methodology work in the Malaysian context?
Yeah, I think that method works globally in the context that okay, so let's say your safe withdrawal rate is 4%, and you get 7 to 8% in the context of you getting the dividend yield. Okay, I want to elaborate a bit more about stocks and dividend. If you buy a stock at 1 ringgit and you get 6 cents in dividend, then your yield is 6%, right? But if over the past next 5 years, the company is able to grow their financials, and the share price move up to, let's say, 1 ringgit 50 cent, and your dividend entitled, you're getting a 9 cent per share, right? So if you use 9 cent divided by 150, probably you get around also 6% yield in that context. But it doesn't matter because your cost of investment is only 1 ringgit. Your yield effectively on that investment is 9%. So on that basis, a 4% withdrawal rate means that you are still reinvesting the balance of the 5%, right? In your case, it's 7 to 8%, which means you have 3 to 4% to reinvest the cash flow that you generated from your investment into your investment again to grow your portfolio, right? And the 3 to 4% is also quite sufficient to fight inflation, at least to maintain the what we call uh, diminishing of our spending power in that sense, right? But if you need to sell your assets along the way, your 7 to 8% is because of you selling the assets, because of the partial of capital gain, then probably it may not be so sustainable. It's because that this year, at the time of you needing the 5% as your uh, cash to survive throughout the year, right? The timing might not be perfect for you to do the SWR, which you withdraw 4% from your investment, let's say every month. It's not perfect timing. There will be never be perfect timing for you to sell your assets or sell your stocks, and then you get the desired return that you want, right? It's a bit more unreliable when you need to actively sell your asset in that context.
Thanks, Max. So the next question by Annalise Chan is that is the investment in PRS, private retirement scheme, similar to unit trust? Is it a good investment for the future?
Now, again, I'm not a financial advisor, but PRS, one thing is good is that you will get personal relief of 3,000 ringgit. I think that's one of the biggest benefit of investing into PRS. But
Tax
if
relief.
yeah, tax relief. And tax is also very important part of our financial planning, although I didn't mention that because I assume everyone here would set aside money to pay for tax every year. I believe we are a good citizen. But um, when you're able to put money into investment and reduce your tax payable every year, I think it will also help to speed up your journey towards financial independence and financial freedom, right? And whether it's an investment in holistic view, yes, I think to answer your question, is quite similar to unit trust or some funds. And is it a good investment for future on a holistic basis? On the tax benefit, I think it's better than some of the funds or unit trusts, although it's quite similar, right? But the investment that the PRS is also essentially a fund. What they invested into, what kind of returns that you will get from the PRS is also very critical. For example, if you are investing into safer PRS, which are bond, I think it's better. But I would suggest you to look at some of the equity-based PRS. You try to look at their return, whether it makes sense to you or not.
All right. The next question is, does the rule of thumb 50, 30, and 20 work to achieve financial freedom? So what he means is that 50% to pay for needs, 30% to pay for wants, and 20% for investment or saving. So that's what he means. Does this kind of uh, money management work? What's your view?
Okay, I would say in your context, 50, 30, 20, probably a bit, for me, myself, I would say probably a bit too much on once. It also depends on how quick you want to achieve financial independence. Yes, that is a quite general rule of thumb. I think it's a quite decent, I would say quite good asset allocation if that's your lifestyle that you want to maintain, right? And 20% on saving and investment in realistically, based on my experience of speaking to different individuals, it might not work on every single individual. Some, they might have family to feed on, they have other commitments, so their needs proportion may be larger, maybe around 60%, 70%. So the proportion of them saving might be lesser, maybe 10%, 15%, or maybe 20%, as you mentioned. So it's very important to look out on your own scenario and try to adjust it. Don't live overly frugally that you will rebound or maybe it will jeopardize your health. Even it's in the short term only. It's not worth it, trust me. Okay, so to answer your question, I would say if you can adjust on the 50, 30, 20, but generally if you have that luxury on so much on the needs, so much on the wants and 20% saving, I would say that's a very good ratio.
All right. So that's all the time we have with Max. Thank you so much, Max, for sharing with us about financial independence. How do we become our own financial manager? And thanks for doing this question and answer session with us. Thank you so much, Max.
Thank you, everyone, and I hope to see you guys in the next session. Thank you, Shane, for moderating as well.